you've ever thought about investing, now is the time, and right now is the place. We're going to be covering a beginner's guide to investing in the stock market. Now, there is an incredible amount of content for this between a couple different sources. I kind of put together some bullet points so you know when, where, and how to invest. Let's go ahead and get into it. So looking at this, guys, the first thing you have to look at is deciding your investment goals. Now, this is important, exactly what you're looking to get out of your investment and your investment strategy. This again is really, are you looking for a portfolio to generate income? Are you looking for passive income? Are you looking for growth? There are a lot of check boxes that you really have to want to look at. Are you looking for IRA accounts? Are you looking at 401ks, which are usually employer sponsored? Are you looking to really save money to your 59 and a half? Are you looking to utilize that money a lot sooner? Are you looking as an investment tool for an emergency fund, which I do not recommend? There are a lot of different things to really run through and do the check boxes to make sure that you know exactly what is the reason why you're investing. To simply say, I want to build wealth is not enough, guys. You have to break it down to really the fundamentals of when it comes to investing. Exactly, this will determine the goal that you're using going forward. Number two, guys, selecting the investment vehicle. Again, very important because depending on where you do your brokerage account, if you're doing it through M1, if you're doing it through another financial institution, if you're doing it through Charles Schwab, we have Fidelity, we have Vanguard, we have TD Ameritrade, you have to be very cautious because a lot of those do charge monthly fees. Some of them also do have a percentage base fee. Some of those also do cover and cost money per trade fee. So if you're putting money, let's say, into your account every single week, if they're doing buys on a weekly basis, let's say it's automated through some investment or brokerage account that you have somewhere, they could be charging you fees on a regular basis when you're going through and doing those original buys. Now, also thinking, are you going to invest in stocks? Are you looking at mutual funds? Are you looking at ETFs? And what kind of flexibility does come with them? Now, again, depending where you have them at, let's say you're investing in the stock market and you're putting it right into stocks, you're buying a bunch of Apple. What is the liquidity you're looking at, and what is the time frame to sell those stocks to actually get the money into your account? Again, that can make a big difference, especially when you look at alternate investment vehicles, when you look at, let's say, Masterworks, so when you look at Fundrise, when you look at a lot of different places, guys, you have to pay special attention to exactly how long it does take to get your money out, or exactly how long you have to keep the money there. That is the reason why a lot of fintechs have been starting up. We've seen Robinhood, we've seen M1, we've seen Webull, we've seen a lot of different ones that really go in and you can invest actually in fractional shares. And again, this is kind of crazy, like with the traditional investing, how easy it is for people in the younger generation to do this today. When I actually started in Invesco, I know Invesco is still around, but Invesco used to be a company you had to mail in a check. Probably a lot of you don't even know what that is, but they would email, or excuse me, not even email. They would send you investment portfolios in the mail for you to invest in based on paper. That is right, guys. It was pen and paper. And I would send a check back to invest with Invesco, which is just kind of dating myself, but also very cool to see how they used to do it. Now, another brokerage option is robo advisors. Now, these have a clear, straightforward advantage. Is the lower fees. When you look at some of them, they have little to no fees or literally almost nothing. Where, for instance, in the Vanguard, the S&P 500, the VOO, it has a 0.03% fee. And also there's no fee to trade when you're using M1, which is exactly why I do use that. Now, calculating how much you want to invest is another big point, guys. You have to really set a budget. This is where it comes into, of course, the big thing I talk about, budgeting when you do the 50, 30, 20. 20% is for debt repayment and investing. How much exactly are you going to be putting it up to start? Let's say you're starting in that investment account with $1,000 and you're planning to put in, let's say, $50 a week, $100 a month, whatever it may be, guys. You really have to determine and outline exactly how much you're putting in. So we've covered the strategy, we covered the vehicle that is taking there. Now it is up to you to calculate exactly how much you want to put in there. General rule of thumb, guys, if you want to retire and you want to retire well, it is 15%. 15% of your income every single year. The earlier that you start this, it is going to be much better, guys. If you start a new job and you invest 15% up front, whatever you take home is your take home income. Let's say in 2 or 3 years, you got a few bonuses, you got a few raises, you're still sticking with that 15%. That is the solid base where you need to start. If you start with the 15%, a lot of people say it is absolutely crazy to start at 1%, start building yourself up. But if you start ground zero with that 15%, you are never going to know any difference. And that is really the big thing, guys, is when you get raises, let's say you get a 3, you get a 5% increase in your wage, in your raise, you're keeping all of that because guess what? You're already putting away your 15%, regardless of what the dollar amount becomes. 15% is the benchmark and where you eventually want to get to. Now, you also have to plan exactly where you want to put your money. This is one thing that you can rely on financial advisors for. Unfortunately, I am not a financial advisor. I am a certified financial counselor, but I do not do the investing side. But you have to know exactly how you're going to do it. If you're going to put it all in at once, as in investing $1,000, are you going to dollar cost average over time? Both of the options really do have advantages and disadvantages that you need to do your research and know. Are you looking for a medium, a short term, or a long term goal? Long term dollar cost averaging is absolutely phenomenal. It is what I do. If you guys have checked out some of my investment videos, I actually dollar cost average every 2 weeks, again, into the S&P 500, which is where I want to. Now, the S&P 500, of course, is getting ready, or if it did not at this point, to go ahead and rebalance. There are a couple companies that are going to be leaving that S&P 500 and a couple that are going in there and actually starting to make a presence in there. Number 4, we look at measuring your risk tolerance. This can be kind of dependent on age. Now, if you're 18, if you're 25, if you're 35, risk tolerance is something that you can do a lot more of. Now, this isn't saying, hey, go crazy into crypto, throw everything into Bitcoin. But this is the point of your life where even if you suffer short-term losses, the chances of you rehabilitating or recouping some of those losses over the next couple of years are going to be huge. However, you have enough years where the big upside is going to be there, guys. If you put money into the S&P 500, let's say in 2022, you realized it was about an 18 to 22% decline, which is huge for a single year. But then you fast forward a year, probably even 2. Guys, this year has been doing incredibly well. We've already almost made up everything that people lost from last year. But again, if you're doing that dollar cost averaging piece, you've been buying it as the S&P 500 went down. So think about it. Every 2 weeks I was putting money into the S&P 500. It continued to decline every single 2 weeks. Dollar cost average, I put X amount of dollars into that S&P 500. When it got to a certain point where it actually turned, the bottom of the market, or when it made that turn and started to increase, since I purchased it all the way down through dollar cost averaging in 2022, this year in comparison, it's almost been going on 2 years now. I am up roughly 44% because of, again, the dollar cost averaging, purchasing the asset when it continues to incline, which is really counterintuitive to what people do. Majority of people think about it. If things are going up, that is the reason they buy, or that is the time they buy, which honestly, again, if you think about it mathematically, if something is beginning to increase or has continued to increase, is it a great time to buy? Answer could be yes when you look at companies like Nvidia or even Apple that continue to increase in value, but it could also be super detrimental because you could be buying it at the very top, which is the reason why I personally do not buy specific stocks. I do not pick out specific stocks, again, like Nvidia, Apple, Tesla, Home Depot, whatever you want to pick. I do not do specific stocks. That is because of my risk tolerance, guys, where I am at age. I do take a little bit of aggressive, but I do it more across the market, which we'll look at in just a little bit. Number 5, consider what kind of investor you want to be. This again is really big picture, guys. If you're willing to take a more aggressive approach, if you're a lot more conservative, again, if you're looking at short term, if you're looking at long term, also, if you're taking short term profits, you have to look at taxation of it. IRS, of course, something that is bought or with a gain or a loss over a year, or that is held less than a year. So again, you really have to break down what you're looking to, if it's going to be short-term investing, if it's going to be long-term investing. And also with the short-term investing, are you talking days? Are you talking months? Are you talking, several months, but less than a year? Where long-term, are you looking at the 10, 20, 30-year averages with the long-term investing? Now, long-term strategy, this is what I use for index investing. And again, I've talked about it before, guys. Vanguard was really the pioneer for index funds. This is taking a bunch of companies in a segment of the market and bundling them together into essentially an index fund, which indexes certain markets depending what it is. Now, like I had said before with the S&P 500, guys, I buy the Vanguard VOO, which is the Vanguard S&P 500. It tracks the 500 largest companies that we have in the United States. It is less of a risk because it is spread across all of these sectors. That is the big thing, guys. When you look at all of the different sectors that the stock market is essentially made up, it indexes or it actually goes across all of those sectors, pulls the largest companies based on the S&P 500 across those, and then you get into investing. Now, another very popular method that has been coming up, guys, is dividend investing. Dividend investing is when you're buying companies that produce a regular stream of income. Dividends are regularly given, but not guaranteed for anything. Now, you have to be really careful with this, guys, because a lot of the high dividends do come with a high risk, and a lot of the high dividends might have a generating a regular income stream, whether it's monthly, quarterly, yearly, whatever it may be for the dividend. But a lot of times the growth factor is not there if you're getting the dividend return. Because remember, with a company, you really have two options. You can pay dividends out to your investors, or you can save that money as an entity, as a company, and actually reinvest it into the company to try to develop it and grow it, which is the big reason between those. Now, number six, building your portfolio. So we've kind of broke down a lot of different factors here on what you can really focus on, but this is the time when you look to build your portfolio. If you're going to go in here and you're looking again at an IRA, a Roth, a 401k, whatever it may be, guys, the most common investments that we see within here are stocks, which again are individual ownerships of the company. When you take the advice of Warren Buffett, he says to look at companies that have value, not so much what they're doing today, but what they have done in the past and what, again, they kind of want to look to do in the future. Companies that you believe in that are well run. Takes a little bit of research, but that is buying individual stocks. Bonds, on the other hand, are company or government entities. You're essentially buying debt from them, and they have a promise to repay that debt with the bonds. However, historically, bonds do not offer as much of a return as we see in the stock market, especially if you're one of the long-term investors where you're going over that 10, 20, 30 years. Now, mutual funds is another one. I know Dave Ramsey is huge on this, guys. As much as I watch, other financial advisors, Dave Ramsey is really big on buying the mutual funds, keeping the low costs, and really there's a way to actively manage them. There's a way to passively manage them. Now, the actively managed is, of course, run by individuals known as fund managers, where passively managed is simply tracking funds like the S&P 500, but in a mutual form. And then, of course, the ETFs. This is what I do, guys. Very similar to the mutual funds, offer the same benefit, but usually at a much lower fee and much more of an opportunity for liquidation and trading based on the ETFs. Again, that is the one that I use, guys. I track the S&P 500. Then, of course, the final one, monitor and rebalance your portfolio over time. Now, this again is kind of a very interesting thing because when you look at the CEO of Vanguard, he was talking about that you should never rebalance your portfolio, that your portfolio essentially will just grow to a certain size. There are some options, even in my personal 401k, you can rebalance monthly, you can do quarterly, you can do yearly if you're looking to rebalance. Now, the only time that I would really recommend rebalancing the portfolio is if you're making a life-changing move or if you're starting to get a little bit older, where you might not have, right now 100% into stocks or ETFs, mutual funds, whatever it may be. You might want to change up the actual percentage allocation in those, again, depending on the closer that you're getting to retirement, possibly branching out into a little bit more risk, or even looking at some alternative methods, whether it's putting a couple percent in like cryptocurrency, doing it in fine art like Masterworks, like I had said before, or even putting some into REITs or real estate. Again, kind of diversifying that portfolio once it gets to a certain size. Now, of course, guys, again, you want to do all of your research before you get into the stock market. There's a lot of things to really think about. Investing doesn't need to be complex, which it is not. Best practice is to limit and make sure that you're not doing trades emotionally. When you look at panic, when you look at fear, when you look at FOMO, when you look at speculation, this is when people see significant losses, and this is when investors actually get burned. It is more of the consistency versus the intensity that I know we talk about a lot. So again, if you're putting money, let's say every 2 weeks into the S&P 500, chances are if you're looking at a 10, 20, 30-year outlook, you are going to have a very healthy and happy retirement when it comes to the funds itself. All right, guys, so that'll do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.